Hello, my name is Sam Shaver, and today I will be presenting my research from my Econ capstone class upon the short squeeze of GameStop and the war between retail investors and hedge funds. First, we'll start with some key vocabulary that will help to clarify this complicated situation. Shorting a stock is borrowing shares that you do not own because you believe it will decrease in value over time and selling them to another investor. A good example is this graphic below. Short seller borrows 10 shares of ABC stock. Short seller sells 10 shares of ABC stock for $500, valued at $50 a share. Over time, the stock loses value. The short seller then buys 10 shares of ABC stock for $400, valued at $40 a share. Then, the short seller returns 10 shares of ABC stock and keeps the $100 profit. This is largely done by firms with more capital at their expense rather than a normal individual investor. A short squeeze is a dramatic and fast increase in the price of a stock as a result of an excess of short selling of a stock. As we look at this bottom graph right here, we can see when Volkswagen stock was short squeezed in 2008. Now, you can see that the stock dipped down right about here, and then in a matter of days came all the way up here. Now, that's a price of over $100 when it dipped almost to $25 in the matter of days. That shows how dramatic short squeezing a stock can change the price. As we look at our current example of GameStop up here, you can see a similar shape of the graph as VW in 2008. You can see that the stock was sitting at around $25 right here at the beginning of 2021, January 1st through the 7th. And then by the end of January, it had reached almost $350 a share. Now that is a dramatic change from less than $20 a share to $350 a share. Now that we understand what a short squeeze is, we can move on to our last page of vocabulary. Our first term is retail investor. This refers to an individual investor who buys and sells stocks non-professionally. I would be considered a retail investor because I am not a professional, but I do trade stocks. Our next term would be the Reddit page Wall Street Bets. This is a Reddit thread created for discussing stocks and trading with nearly 10 million retail investor members as of April 2021. This page, this thread, was the primary driving force behind the short squeeze of GME, and I will explain why shortly. Next, we have Robinhood, which is a free trading app designed to allow users to purchase and sell stocks without commission, and it was extremely popular among these Wall Street Bet users. Lastly, we have a hedge fund. This is a pooled investment fund that is generally managed by an individual or a group of individuals that uses higher risk methods such as shorting, as explained before, to attempt to realize large capital gains. Relevant examples of hedge funds would be Citadel Securities and Melvin Capital, both of which we will discuss later on in the presentation. Now let's look specifically at the short squeeze of GME, which is the ticker for GameStop's stock. A short squeeze occurs when a stock or other asset jumps sharply higher, forcing traders who had bet that its price would fall to buy it in order to avoid even greater losses. Their scramble to buy only drives the stock's price upward. An investor might try to predict this situation occurring by observing the number of shares shorted in comparison to the number of shares outstanding. I'd like to direct your attention to these numbers right here. This first number that I circled is the amount of shares shorted. You can see it is 67.45 million. Now let's look at the shares outstanding. It is 65.16 million. The Wall Street Bets Reddit page noticed that the shorted shares exceeded the outstanding shares, and members began buying shares, hoping that a short squeeze would occur. Hedge funds such as Citadel and Melvin Capital, who were shorting shares, bet that the value of the GME stock would go down and they would be able to buy it back to make a profit. Enough retail investors who were members of the Wall Street Bets Reddit page were buying the stock to where the price began to go up, and various hedge funds such as Citadel and Melvin Capital had to start buying back their shorted shares at the higher price. Like I mentioned before, this only drives the price up further and further. Hedge funds were facing massive losses on their shorted shares since they had bet that it would go down in value. I'd like to highlight exactly where this occurred. It began to occur right about here, and you can see slowly but steadily it rose up and up and up to the peak of $347.51 a share. There was a difference of $337.04 between the 6-month high of GME and the 6-month low of GME, which is essentially unheard of unless it's a situation like this with a short squeeze. On January 28, 2021, Robinhood revoked the ability to buy shares of GME from its users, citing extreme market volatility as the reasoning behind their limiting of the ability to buy. In an email sent out to all of its users, they said that they were taking action to protect them by protecting them from this market volatility, aka the short squeeze of GameStop. Since this freeze made it to where retail investors couldn't buy stocks of GameStop anymore, it directly drove the price down. This obviously harmed retail investors because now their current holdings, their current amount of stocks of GameStop are worth half as much as they were the day before because of this freeze. Now, this benefited Wall Street establishments such as Citadel and Melvin Capital because they were able to fulfill their shorted stocks at a lower price than they would have had to before if Robinhood wouldn't have limited the purchasing of GameStop stocks. Now we can begin to look at the general effect and the general response to Robinhood's actions. As discussed previously, retail investors using Robinhood and various other trading apps lost the ability to purchase shares of GME, effectively driving the price down overnight from $300 plus a share to less than $100 a share. Retail investors holding shares of GME lost anywhere from hundreds to millions of dollars as a result and were understandably furious. Various household names such as Elon Musk, Mark Cuban, Pat McAfee, Elizabeth Warren, Ted Cruz, and AOC spoke up publicly about the injustice done. Now at this point, this situation is very much in the limelight and the public eye. So, on February 18th of 2021, the U.S. House Financial Services Committee held a hearing about GameStop stock and Robinhood's role in preventing the purchase of GME stock. Vlad Tenev, who is the CEO of Robinhood, consistently skirted questions from the men and women of Congress about the reasoning behind restricting purchases of GME. He kept citing the same reasons as before, that he was protecting his users from extreme market volatility. Mr. Tenev directly denied that the reasoning behind Robinhood's action was motivated by any of the hedge funds directly affected by GME's rise in price. For example, Citadel and Melvin Capital. No resolution was agreed upon as a result of the hearing, merely that Robinhood would commit to doing better in the future. So now, let's take a look at how these hedge funds benefited from Robinhood's actions. First, we'll take a look at Melvin Capital, who suffered a 53% loss in January before Robinhood took action. This is directly because of the short squeeze and because they had so many shorted shares that they had to buy back at this higher price. They lost billions of dollars. However, they enjoyed 22% growth in February after Robinhood took action because they were able to buy back their shorted shares at a lower price. Citadel Securities reloaded on their short positions right before Robinhood limited trading of GME and cashed out after the price dropped as a result. So essentially, Citadel doubled down on their bet that the price was going to go down, and then directly after Robinhood limited it, they were able to buy back their shares for a profit. So now that we have a broad understanding of the situation, I just wanted to raise some moral and ethical issues that I noticed throughout my research. Number one, should companies be able to control the way that you spend your money? Number two, is it fair for Robinhood to take action to protect its users without its permission? Number three, how does a retail investor, that's an individual investor like me, bridge the massive gap between their opportunity for capital gains and the opportunities of hedge funds? Is this even possible? What action, if any, should be taken against Robinhood, Citadel Securities, and Melvin Capital for actively participating in market manipulation? What legislation, if any, should be put in place to prevent a similar situation from occurring in the future? As I conclude my presentation here, I really want to drive home the injustices of this situation and what it means for our economy. If massive hedge funds are able to manipulate the market to best fit their needs, how is any retail investor going to be able to get the same type of returns that a hedge fund gets on a day-to-day basis? There's a fundamental issue with the way that our stock market is built that helps the rich get richer but limits the ordinary person from attaining the same wealth. I think the solution is stricter market manipulation and financial laws and actual consequences when said laws are broken, not just a minimal fine and a slap on the wrist. Thank you for listening.